The FASB and the IASB continue to redeliberate on their joint project on leases and have proposed some significant changes to their exposure drafts issued in 2013. While the boards have reached converged decisions on some aspects of the project, there continue to be key areas in which their decisions have diverged, but they continue to make progress toward issuing final standards. Welcome to the KPMG Podcast and the FASB IASB Joint Project on Leases with a focus on lessee accounting. Today we'll discuss project status and provide an overview of the key decisions reached through December 2014. My name is Robin Van Voorhees, and I'm joined here today by Dan Amott. We are both senior managers in KPMG's Department of Professional Practice. Dan, can you start out with an update on this project, and when can we expect to see a final standard?
Sure, Robin, thanks. Before we look at status, it's interesting to go back and reflect on the four main objectives that the boards set for this project, because as we currently stand, it appears the project may only achieve the first objective on getting leases on balance sheet for lessees, although the scale may tip on the objective related to reducing complexity, depending on how the last few redeliberation meetings go. It's been a long journey, definitely, and with only a handful of remaining issues to be discussed, we expect that the boards will see the project through and they'll issue their individual final standards by the end of 2015, which would mean an effective date no earlier than 2018.
All right, so what are some of the major decisions to date that might impact lessees?
Well, the boards have agreed to keep lease definition as it's spelled out in the 2013 exposure draft intact, and they've discussed further clarification to when and how the aspects of the definition, which are shown on this slide, are applied. You'll see the definition focuses on two things: control over the use and then of an identified asset. So what is an identified asset? A couple things. It is physically distinct, or it is a distinct portion of a larger asset, as opposed to just generic capacity. And the supplier does not have a substantive right to substitute another asset. So a right to substitute would be substantive if the supplier has the practical ability to substitute an alternative asset, and the benefits to that supplier of exercising the substitution right would be expected to outweigh the costs. So that's identified asset. How about control? A contract conveys the right to control the use of an identifiable asset if, throughout the term of the contract, the customer has the ability to, one, direct the use of the identifiable asset, including changing how that asset's used, and two, obtain substantially all the benefit from use of that identifiable asset.
Okay, Dan, so I get this new lease definition here, but how does it really compare to that existing definition of a lease in the current guidance, and what might this effect of a new definition have on users?
Well, current GAAP lists three conditions, any one of which would indicate a lease. The first two are generally consistent with the theme of this new definition, but the third states that an arrangement may be a lease just based on the fact that the customer obtains substantially all the output from the asset during the term, regardless of the customer's ability to direct the use. So some agreements, such as a power purchase agreement, that are leases under current GAAP because of this third condition may not be leases under the new standard. This change in definition will really require all entities to reassess current leases and service arrangements upon adoption of the new standard to determine whether lease accounting applies or not. The new definition is unlikely to change the conclusion for most common lease arrangements, but the result could be different for outsourcing and similar arrangements that include significant services. So the implementation guidance and illustrative examples in the final standards will really be critical in helping entities make this evaluation. Now that's a lot of detail on definition of a lease, but the distinction will be critical because the assessment of whether an arrangement is or contains a lease in effect is the new test to determine whether an arrangement is on balance sheet or off balance sheet for the customer. And realistically, it's likely to remain a key judgment, however hard the boards work to clarify and supplement the definition. So the boards have also agreed in redeliberations to change the 2013 exposure draft threshold for whether a lease term should include option periods and that threshold's been changed to reasonably certain. The intention here was to maintain the high threshold that's in current GAAP for inclusion of option periods, while providing a criteria that's more commonly understood in current practice. This reasonably certain decision will be an economic analysis, as that term is currently used in current GAAP. If we go to the next slide, we see a summary of the various types of payments that may be included in the calculation of lease liability and right-of-use asset. There's a few nuances here that I'll note. One is on purchase option. So a purchase option price will only be included in the total of lease payments if it meets that same reasonably certain threshold that is in place for option periods. Next, variable lease payments. So variable lease payments will only be included in total lease payments for purposes of measuring lease liability if those variable lease payments are tied to a rate or index, or if they're in substance fixed. And for variable lease payments that are tied to a rate or index, the lessee will calculate that using that rate or index at lease commencement. Last thing I'll note is that for non-public entities applying U.S. GAAP, those entities may elect to use a risk-free rate in discounting these lease payments for their liability calculation.
So you have this note here on the non-public companies and discount rate, but how will public companies determine discount rate?
Yeah, public companies must use the lessor's implicit rate if it's ascertainable. If not, you're required to use your borrower-specific rate that you'd pay on a similar loan amount, similar time frame, similar asset to that right-of-use asset.
All right, got it. So how does this here translate to how a lease liability and asset will be booked to the balance sheet?
Well, lease liability is going to equal the present value of unpaid lease payments. So the lessee will accumulate the various payment streams we just covered as applicable. They'll present value them using an appropriate discount rate. They'll back out any upfront cash payments, and then that will become the initial lease liability. That lease liability will be amortized over the lease term using an effective interest method, similar to other debt. Now, how that interest expense is presented on the income statement will depend on whether the lease is classified as Type A or Type B, which we'll cover in a bit. So we've got our lease liability. That becomes the starting point for the ROU asset, or right-of-use asset, with other items shown on this next slide potentially getting added or subtracted from the lease liability to get to the ROU asset that gets booked on day one. As with the lease liability interest expense presentation, subsequent measurement of the ROU asset and that amortization expense will depend on lease classification. So as we currently stand, the IASB has decided on a single model approach for lessees, where all leases, with some targeted relief exceptions, will be treated as Type A, which is similar to how a financed asset purchase is treated. So what that means is the ROU asset is amortized straight line, and that amortization expense is presented separately on the income statement from the lease liability interest expense, which would be presented on the interest expense line of the income statement, so below operating income. The combined impact, if you were to look at them together, would be a front-loaded expense pattern. The FASB, on the other hand, has decided on a dual model, where Type B leases would combine ROU amortization expense and lease liability interest expense into one straight-line rent expense on the income statement, similar to how operating lease expense is presented under current U.S. GAAP. And this is accomplished by plugging that amortization expense each period to get to your straight line expense.
All right, so that seems like a pretty significant difference between the IASB and the FASB and their conclusions on how to account for, Type A, Type B leases. So I think that's what a lot of people are talking about and what we hope to hear more about. But otherwise, we'll see some key divergence in that area. So how has the FASB decided to differentiate then between Type A and Type Bs? What's their classification test?
Well, the classification test will generally be consistent with current requirements of IAS 17, the IFRS lease guidance, ironically, which is similar to current U.S. GAAP requirements but without some of the bright lines. So on the next slide, we go through a small decision tree that walks through the lease classification test questions. So if you have an ownership transfer at the end of the lease or a bargain purchase option, you're going to be a Type A lease. If you don't have either of those, the lessee must ask themselves, is the lease otherwise transferring substantially all the risks and rewards incidental to ownership to the lessee in that lease? Indicators of this include a few things. One, is the lease term for a major part of the economic life? So this would be similar, if you think about U.S. GAAP today, similar to the 75% bright line. Second indicator is the present value of lease payments, substantially all the fair value of the underlying asset, so that'd be similar to the 90% bright line in today's U.S. GAAP. Or thirdly, is the underlying asset so specialized that it has no alternative use to the lessor? If you answer no to all these questions, a lease is going to be classified as Type B under U.S. GAAP and get straight-line rent expense pattern, all above the operating line. As you can see, most operating leases today will end up as Type B leases, and most capital leases today will end up as Type A leases.
Great. Thanks, Dan, for that summary and that update. And thanks to our audience for tuning in. Please visit our Financial Reporting Network for more information on the FASB and the IASB's joint project on leases, as well as for other ongoing projects and recently issued standards.